Okay, I think we are live. Welcome, everyone. Thank you for joining us for the Icaria Fund Discovery Session, hosted by Revolve Capital. We've got a lot of people joining. I'm seeing a lot of people jumping in. We'll give it a second or two longer. I know we're about at 12:04, but thank you for joining, and we're excited to kick this thing off. Gentlemen, how are you?
Very well, thank you, Hayes. Very good. Happy Thursday.
It's good to see you both. I'm excited. This is going to be a fun webinar. You guys excited?
You know, we haven't been in front of our folks in front of a long time, right? So to be able to introduce new ways to work with each other, talk about product, the flow of it, what 2023 looks like. Heck yeah, we're excited.
Let's get into it, boys. All right, so let's keep it moving. Here we go. I think we've got everybody in, and just so that
They're still flowing in. They're still flowing in.
Yeah, they're flowing in, and let me just go ahead and make sure everyone knows this is being recorded, and so we will be distributing the recording via email to everyone who is on the webinar and anyone who couldn't make the webinar, including the disclaimer. I'm not going to read the whole thing and bore everybody, but this is something you can refer back to with the recording. So let's keep it going. So I am Hayes Brumbeloe, Chief Development Officer. I'm joined by Marc Blunden from London and the one and only Mr. Chaz Guinn, Chief Executive Officer. We are excited, and we are excited to jump into this fund. A little bit about myself. My name is Hayes Brumbeloe, and I have a longstanding experience in building brands with multiple companies that I've started. And that is what kind of brought me to the table here at Revolve Capital. But however, a year ago, I knew nothing about this space. I knew nothing about buying notes, and I'll be the first one to raise my hand and say that. Clearly, I discovered that it's a very small door in entering this space. You guys have done a great job of hiding this wonderful investment, and a part of my job here at Revolve Capital is to make as big of a door as possible. The team has done an outstanding job of building a huge database of buyers, and that database of buyers is growing by the month, and to the tune of $200+ million that they can take down in assets very quickly. My job here, if I'm just whittling it down to what I do here, my main focus is building that deep bench of buyers so that it feeds directly into this fund. We raise capital, we leverage that capital, we buy a lot of properties, and then it's our database of buyers who then rinse and repeat. That's the growth strategy here. So my main focus here at Revolve Capital is making sure we have a deep bench of buyers so that we can take down more properties and keep the rinse and repeat, the revolving of capital rolling. So let's keep it moving. So this is a big deal. So historically, Chaz and Revolve Capital has raised their capital through institutional funds, family offices, extremely large net worth individuals. This is a very special opportunity. I think as an outsider looking in, again, a year ago, I knew nothing about this space, but I can tell you right now, this is a huge opportunity, especially looking at what the market is presenting itself as. This is special. And from conversations I've had with Chaz, along the way, he's had numerous people come up and say, how do I just, I'm at a point in my career where, yeah, I don't really want to be so hands-on. I want to kind of have a hands-off approach. I'd love to be able to invest just into what you do. You're good at what you do. You're great at what you do. And I'd love to invest into you, that kind of thing. And it was never in the play. This is brand new, and this is a huge opportunity. That's why the quote is, I mean, it basically lays out how special this is. And we hope you'll take full advantage, because I'm telling you, this is a huge opportunity, huge opportunity. So let's keep rolling. Most of you on this call are very familiar with Revolve Capital and Chaz. You've worked with them for a long period of time. Since 2018, we've taken down over 1,000 houses. market value of over $200+ million. So you guys are very much aware of the product flow, his credibility, the company's credibility. It goes without saying. Obviously, our PPM goes much deeper into that, but that's not why you joined this webinar. You want to hear more about the nuts and bolts. So let's keep this thing moving. The Icaria Fund. Welcome to the Icaria Fund. Again, it's an amazing opportunity for our investors, our buyers, those who have been working with us for a long time to jump in and play alongside us. You'll notice the Icaria Fund is based after some Greek names, the Mykonos, Icaria. There's a reason for that. So a former partner of Chaz's, Claudia Newcomer, passed away a few years ago unexpectedly, and it played a huge role in this business, played a huge role from a personal and a professional standpoint. And this was kind of a hat tip to her to keep her still a part of the fabric of Revolve Capital moving forward. So you'll notice that there's a lot of Greek. I'm sure somebody's like, okay, who's got the Greek mother? Who's got the Greek grandmother? It ties back to Claudia, and we so that gives a little bit of understanding on Icaria's name and Mykonos. So let's keep it moving. Next up, before we jump into to Marc Blunden from London, I'd love to get a show of hands. There's a button down there. You can say raise your hand. Just hit that button if you are an accredited investor. We'd love to make sure that everybody on here is an accredited investor, because obviously our Reg D fund is for accredited investors. So hit that button, and we'd love to hear from you. Mr. Marc Blunden, the stage is all yours, sir.
Thank you, Hayes. Thank you for the introduction. So as the quote says, with our experience in this space, decades of experience, and the product flow that we continue to see month after month, we're really excited that we've now filed the Icaria Fund and we're ready to subscribe investors. So without further ado, let's look at some of the terms of the Icaria Fund. Icaria Fund is an LLC and it's registered in the state of Delaware. The manager, as Hayes mentioned, is Mykonos Management LLC. That's another Greek island. The managers are Chaz, myself, Ray, Mika, and Hayes. Together, we have over 3 decades of experience in the mortgage note industry and over 5 decades of experience in management more generally. So we're well equipped to run this fund. The investment objective, the main objective, as with Revolve Capital's business in the past, is to programmatically acquire, manage, and sell mortgage notes backed by residential real estate. The minimum size of the fund, in order for us to break escrow and begin allocating, is 2.5 mil, and the maximum size of the fund is 50 million. The share price is $1,000, and that applies to whether it's a Class A1 or A2 share. And we'll look at those in a little more detail on the next slide. The minimum subscription amount for an investor to join the Icaria Fund is $50,000. So Class A1, if you invest between $50,000 and $250,000, you're a Class A1 shareholder and you will earn a quarterly pref of 8%. If you invest over $250,000, you'll be a Class A2 shareholder and you will earn a quarterly pref of 10%. The fund has the ability to lever the equity capital 2.5 times with debt. So our maximum debt to equity ratio can be 2.5 to 1, and that will really help us enhance our returns back to the shareholders. The waterfall or profit share upon liquidation is 50-50. So 50% goes to the Class A shareholders and 50% to the manager or Class B shareholders, pro rata. The offering is live now. We can subscribe investors today, and it will run through May 9th of next year or until it's fully subscribed, whichever comes sooner. And we're pretty confident it's going to be fully subscribed within the next month or two. The fund term. So the fund will allocate, it will spend dollars purchasing NPLs and RPLs for 3 years. And then the liquidation period will be 1 year, ideally, but up to a maximum of 2 years, subject to market conditions. So we can exit the last remaining properties at the best possible level. And while we allocate for 3 years, it's worth noting that our revolutions of our capital are 1.7 times per year. So over the 3-year allocation term, we're going to revolve through the capital 5 times. That's again going to enhance our returns back to the shareholders. So what does all this mean? We've got 2 different investment scenarios here. This is based on a subscription of 30 million equity paired with 75 mil of debt. So if we fully subscribe up to the 50 mil of equity, these returns will be even greater. So on the left-hand side, we have a scenario for a Class A1 shareholder. They invest $100,000. They'll receive their 8% quarterly pref payment. That's $2,000 per quarter or $8,000 per year, adding up to $24,000 over the allocation term of the fund. And based on the raise, we're projecting a profit share for that investor of $50,000. So the 50 and the 24 combined gives that shareholder a total dollar return of $74,000 on their initial $100,000 investment. Now, Class A2, if you invest $250 plus, on the right-hand side of the screen, you're earning a 10% pref. So based on a $250,000 investment, you'll earn $6,250 per quarter or $25,000 per year pref, $75,000 over the allocation term of the fund, and we're projecting that investor would receive a $125,000 profit share upon liquidation. So combined with the pref payments, that's a total dollar return for that shareholder of $200,000.
Mark, I don't mean to interrupt you, but so an investment of $250,000 gets you your $250,000 back plus $200,000. Am I reading that correctly?
Absolutely. That's projecting based on historical performance of Revolve Capital and what we're seeing in the market today.
And where else in the market today are you seeing something like that?
That's
if you do, please email me right now.
Right.
I'm all ears. That's outstanding. Thank you, Mark.
Yeah, of course. Thanks, Hayes. Okay, management compensation. There's 4 broad categories. The first 2 on the left-hand side are really the pertinent ones. The asset management fee is 3%. The acquisition fee is 1%. So a combined 4% for the managers to run the fund. On the right-hand side, we have built in a property management fee of up to 6%. So that will be applicable if we gain any REOs, maybe at a foreclosure auction, and we determine the best course of action is to rent that property out for a period of time. We have built into the operating agreement that we can pay up to 6% to a property manager to handle that for us. And similarly, we take an REO, we determine it needs some rehab or construction. We've got built into the agreement the possibility to pay up to 3% to a construction manager or REO vendor to manage that property. Okay, last section for me is on use of proceeds. So we've got two scenarios on the next slide. One is for the maximum subscription of $50 million, and the second one is for the minimum subscription of $2.5 million. So you can see in that top table, max proceeds are either 50 mil or 2.5 million. The second section, that lower table, shows that the cost of building and filing the fund was 100,000. That doesn't change regardless of the amount we raise. The brokerage commissions. So our existing broker dealer is charging 1.9% to raise capital. We've got built into the operating agreement the ability to charge higher. 1.9 is low, but that's what we've engaged with right now. So the total offering fees are either just shy of 200,000 for the minimum raise and 1.85 mil for the maximum raise. This slide just shows how we're going to use those funds. So the top section shows the working capital. That's how much money we need to keep aside in the checking account to run the day-to-day of the fund, 50,000 up to $1 million, subject to the size of the raise. That leaves us in the middle section, the funds available for acquisitions. And this is the key takeaway from use of proceeds. So the minimum raise gives us the ability to spend 2.2 mil out of the 2.5. And the maximum raise gives us the ability to spend 47.15 out of the 50 mil raise. So what it boils down to is for every dollar that's invested into the fund, we're able to spend up to 96 cents. So 96% of the raise is spent doing what we do best, which is the programmatic acquisition, management, and sale of these mortgage notes.
That's outstanding.
And that pretty much sums it up. Thank you. Back
Marc,
to you, Hayes.
Thank you. Thank you so much, because that gives everyone a much better understanding of how the fund is going to be utilized. So thank you, Marc. It's now time for the man of the hour. Everyone on this call knows who Chaz Guinn is. He's our rock star. He's your rock star. Mr. Chaz Guinn, step on up to the mic, big guy.
Appreciate it, guys. So hopefully you guys are having a little fun. 2022 for us has been I guess I would say a little bit more of a quieter year with respect to how consistent we were in putting out product in front of you guys. But the data is showing how much that will change for 2023 and far beyond all of that. So that's why we're more excited. And historically, especially over the course of my career, dating back to 2011, when I really started raising large amounts of private institutional capital. When I say private, that could be, family offices that are raising or that are managing anywhere between 2 and 4 billion in terms of actual capital, but then maybe allocates 50 million our way just to kind of do a test pilot case before they allocate more cash. So that's been traditionally the way that we have not only managed or raised capital, but kind of the marketing channels in which we would go to really partner with money providers, money capital partners. So that being said, I've just crossed so many of you over the course of the last 15 years that we've traded to thousands of you. And over the course of that time, many of you have been pushed away from being able to invest together. And gone are those days. We wanted to be able to create a vehicle that says, hey, market, yes, we can invest with you, or you can invest with us, I should say, but also we can still sell to you. You can still become a buyer of assets, right? So you can still allocate notes from us, especially because we manage multiple different vehicles. However, we wanted to look at our accredited investor fund, especially there's hundreds of you in our database that say, hey, look, we haven't seen as much product as we thought in 2022. I'm sitting on quite a bit of capital. I got to do something with it. It's got to make me some sort of return. And that really was kind of the nature of us building this Icaria fund. So that is really what the nature of our excitement and why we're looking at 2023 with a much different view than we did in 2022. So we can keep going. 2000, I get this question a lot, is like, what are you seeing? Is this market going to be like 2008 and 2007? Is the crash going to happen? And no, the lending standards and the credit looseness 15 years ago is much different than it is today. We all know this, right? To be able to get a mortgage back then, all you had to do is just simply have a pulse and a decent credit score, and a $250,000 or $500,000 mortgage could go into your name. And so, honeymoon rates, balloon rates, option arms, pick-a-pay loans, NINA loans, no income, no asset, were very familiar terms back then, where today's credit borrower has a much tougher time getting qualified. So this is a lot of the foundational pieces as to why we don't think the market's going to tip over, but it will recede. And because it will recede, it will cause legacy loans, pre-pandemic loans, to begin to hit the shores of buyers and investors like ourselves, right? So 2016, 17, and 18 product has been the majority of the loans we've seen here in 22, and the majority of the loans we'll start seeing in 23, which is 5-6 year delinquent paper that got bailed out by the pandemic, right? You couldn't foreclose, you couldn't evict for 2 years. So there were already 2 and 3 years of delinquency on that paper or on that debt prior to the pandemic that got bailed out. So they played the forbearance game or the modification game during COVID. And now, because that game is up, the lender, the judicial courts are now realizing no more. Let's proceed. Okay, so we're starting to see so much more legacy product, which is really the majority of what we are going to see as a buying community. We're not going to see today's delinquent paper that we know is going to happen in droves. You all are seeing massive layoffs, not only in the tech space, but in just the general productional space in our economy is starting to recede. Inflation still remains at all-time highs. Certain coastal markets still have all-time level of gas highs. So, today's average day consumer is really feeling the pinch in the pockets, and it doesn't help heading into the holiday season, right? So these are all data points for us that say that there's going to be some sort of hemorrhaging in today's product level, but that we won't see that stuff until 2024, 2025, in terms of being able to buy that stuff in droves. So today's distressed market is going to be different than we did see in 15 years ago. I think this next slide kind of illustrates that. Today's, and all of us can look at the headlines, and all of us can show that, you probably have heard me say this before, but that facts tell, but stories sell. So I'm really always trying to find what's the commonality of the story of what today's market really looks like. And I think, truthfully, if I had to just shoot you between the eyes, I think a lot of the words that we're hearing are scary terms, scary words: recession, inflation, pullback, layoffs, fear, right? And sure, I do think that we're going to see pullback. We are seeing serious delinquencies increasing month over month, quarter after quarter. We are seeing that, we saw that FHFA, right? The Federal Housing Finance Administration put out multiple articles, multiple publicly accessible documents that you and I can access at any point that show that 154,000 non-performing loans were sold in 2021 alone. And that's just one agency, one entity, right? And the average delinquency on that mortgage paper was 3 years, okay? But what still remains on their balance sheet shows an average delinquency, just their non-performing loan balance sheet, their average delinquency sits at 6.2 years, right? We have these articles to share. They're publicly accessible as well. But that shows me, where's that product, right? And that product's been held by major banks because they've been trying to work through it, while appreciation of homes have been on a tear over the last couple of years. They almost felt like the delinquent homeowner could just pay them off because they could. The rates were at an artificially low rate, as you all know, right? Rates were super low, 3%, 3.2%, 2.8%. What did they say, Hayes? Like the average, the 55% of today's mortgage owner sits at less than 4% rate.
Yeah, it was like 48% is less than 4%.
So that being said, I mean, a lot of folks have today's rate that is what, multiple points, hundreds of points below today's 30-year fixed, right? So we see that the refinance play that borrowers were doing over the last couple of years, that's going to stall. You just selling your property so you can cash out the equity you were sitting on and you can just go rent so you can wait for the market to subside a little bit. That game's not happening anymore. Who's buying your house? Who's going to qualify to buy your house, right? So that game changes. So this is why, guys, a lot of the delinquent paper is starting to come to our shores. And that's why we want to partner with you, right? So you could take advantage of us being able to buy in a valley. We all know peaks and troughs. And today we're starting to really being able to buy in a trough. In 2023, we're starting to do a little bit of this because
It's coming right to us.
the pricing's making sense. Like Hayes says, that we feel like it's coming right to us. If you're a surfboard, I feel like I'm starting to paddle even faster because I'm ready to go. So again, that's data that we're starting to see that's kind of helping to build the foundation of why we feel that way. So we can jump forward. So look, Revolve Capital today marks, so December of 22 marks, just shy of 4.5 years of being open. So, I've been in this space for 15. Many of you know me at prior shops, and Revolve was, the first way for me to kind of get into the GP role, right? The general partner role, have LPs, limited partners that are alongside of me that helped us grow. I had really good seed parting capital that helped us get started 4.5 years ago. And where we're looking at taking the fund today is really kind of piggybacking a lot of our fund management ability and experience. I've been doing this. I mentioned this is my 17th fund. Believe it or not, I've been raising Reg Ds since 2011. Just crossed $280 million of dollars raised. So I've done this a little bit, right? And after being open for year 4, so our 48th month, which was in August of 22 this year, we had purchased so far 47 portfolios, right? So just shy of one a month that we were acquiring. And the average portfolio size was 25 properties. So smaller than traditional, but I would say about 100 to 150 of loan size is traditionally what we typically take down, okay? So in terms of deal flow expectation, even though we've been open for 4.5 years, we're still sitting at 52 portfolios purchased, right? So we're outpacing now how long, right? We're starting to be open. So we're a programmatic buyer. So the Wall Street, the government, they know that every single month we have dry powder, we have systems and underwriting ready to go, okay? So you guys as partners of ours would get to take full advantage of a programmatic buyer. Okay, we have worked my tail off to get into the seat of sellers that are not being shown product that's being shown to the market, right? We negotiated trades. I'm able to talk about available capital. I'm able to look at a large population to underwrite. I'm able to win bids and get into diligence. We do not auction bid. We do not compete against other counterparties. A lot of my contemporaries, a lot of my colleagues in the industry, they compete. They bid against auctions. They deal with brokers. We deal direct. It needs to be very clear, right? With tier 1 institutions, folks that are sitting on 25 billion or more of assets or products, potentially in this asset class alone, that sit with enough product to just show us thousands a year, right? And that's just one entity, okay? So we're a proven buyer with over 15 tier 1s, not to mention the government. So we bring this sort of deal flow to you guys. That's why we're excited. So jump in. We talk a little bit about, and I know we're in the thick of it here in the latter part of the year. This is like the sports haven. We talk, basketball's at an all-time high. We just, a month or so ago, we just had the World Series done. Hockey's going, football's firing off. And so let's just use football, for example, is we definitely use a 3-pronged approach of how we manage assets, right? So offense, defense, and special teams, okay? So offense is many of our buyers, many of our fix and flip folks, many of our passive investors that are maybe sitting on $1 million net worth that really like mailbox money, really like RPLs. We have a lot of contractors, GCs out there that really like later stage foreclosures, that want to be able to create their own fix and flips to either reflip or create their own rental portfolio, right? And then we also have a lot of folks out there that traditionally buy for their own consumption, right? They roll their sleeves up and they do a little bit of what we do. So that number one that you're seeing on your screen, our note buyer database, is we facilitate a lot of product to this database, and we have for well over a decade. And Hayes mentioned this early on in the presentation, that we are growing organically. This database is coming in droves weekly now, and starting to expand as we're starting to kind of come back out there with not only product opportunities, but investment opportunities, collateral document opportunities, right? So we facilitate a lot of product to our database. I would say that's the offensive part of our business. We help to rinse and repeat a lot of what we do. The number two is I would say is the defensive part. We, for one thing that I kind of hang our hat on, is we have yet to have to foreclose and displace a family over the 10,000 units that I've acquired in my career. Now, sure, some of you have. Some of the product I've sold to you, you may have foreclosed on those borrowers. However, us at Revolve, we really try and work with the borrower. We find that foreclosure is costly and it's expensive and it's timely, right? However, it's a necessary evil. We all know this, especially on vacancy, especially on knucklehead borrowers that don't call back, don't have the economic means to stay and pay. So number two here is we really convert non-performing loans into reperforming, and we're really good at seasoning up those assets. And why we're good, guys, is we give common sense modifications. And Hayes and I always joke around that common sense now is a superpower. It's not as common as you may think anymore. But for us, common means, do you have a stable job? Are you filing your taxes? Can you prove this stuff to us? Does your DTI, your debt to income, make sense for you? Could you potentially wake up in cold sweats 3 to 6 months from now, not knowing why you're making this new mod payment, right? So our attrition rate on our portfolio sits at all-time highs. We sit at a 92% attrition rate over the last 650 mods that we've done over the last 4 years. So if you think about, 5 years. If you think about that attrition rate, that's meaning less than 10% of the folks are waking up in cold sweats, right? We're fixing the problem, and we're not just putting a Band-Aid on that wound. We're realizing, look, you may not be able to afford this property any longer, Mr. Jones. Let's just face that fact. And or you do, but the $1,200 payment's not sustainable. Could you do $800, right? So our servicer, working with our servicing team, they're really good at converting non-performing into reperforming and seasoning up payments, and then us being able to reestablish consistent, good reperforming loans back out into the market. So that's the defensive part of our business. Let's hop into the special teams. So we've all been enjoying where the market's been over the last few years. We're not special. Again, most were just putting a for sale sign in front of their house and selling it $100,000 well over asking, right? We know that the market's not there. We know that there's receding. However, if you are able to buy in a bulk fashion like we have been, you're able to get steep discounts on the portfolio, and we can assess those at a loan level, right? So for vacant, rule, abandoned, that type of product, we kind of price that in. We always talk about there's no bad properties, there's just bad pricing. So upstate New York, litigated New York, excuse me, Alaska, any sort of rural, remote location, we will still dip our toe in that, but our model will price it in accordingly. How long does it take for us to get to the real estate? That sort of thing, right? So the vacant part of our business is the special teams, where we've been really good at being able to generate. Do we sell just as is? Do we get into the fix and flip play? Do we want to create these into rentals so we can create cash flow, bundled up cash flowing rentals that we can eventually repackage and sell, right? This is a different part of our model. And we kind of encourage a lot of our buyers to adopt this strategy because it helps them hedge. It helps them be nimble into not being focused into just one strategy, okay? Keep going. So for us, you guys, and we're going to give you a little bit of our secret sauce, but we hope that it adapts into the market. And we've called this different acronyms and different names over time. We had it as VOT, value, occupancy, title, and taxes, that we would underwrite on an individual basis per portfolio. But look, from an acquisition process, the market, we'll take down 100 properties at a time, but we individually underwrite everything. Most of you do as well if you're a buyer. However, the reason why this becomes key is because we, as a manager of assets, is we deal with our tails, you guys, from the onset. We don't let our tail become the tail at the end of the portfolio. And here's what I mean. We address rule, vacant, litigated, long foreclosure, unwilling borrower, missing collateral, defects, anything that could cause that property to not sell or not sell quickly. We deal with these tails from the onset. We sell them quickly. We address what could be an exposure for us in the early part of the portfolio versus the later part of the portfolio. And the strategy there is that allows us to end up with cash flowing properties or properties that are in late stage foreclosure that we want back as real estate. We're not stuck with tails. Okay. So from a management standpoint, you can take that and adopt that into your business, because tails should be dealt with from the beginning versus the end. And because we deal with them from the beginning, we don't get left with tails at the end. So regarding a 3-year fund, as we're allocating for the 3-year period, we are dealing with tails every month, every quarter. So when we start getting into liquidation and wind mode, we're liquidating cash flowing properties and stuff we wanted to get to real estate that we're having on the market now, that we have a for sale sign on, stuff we want to sell, right? So we're not sitting there with stuff that's rural or mobile homes or stuff that's really, really problematic to get rid of, right? So it's a little bit of our secret sauce for you regarding, our processes and a little bit of our scalability there. This kind of just highlights the different, we're really aligned with tier ones, large real estate funds. Large real estate funds could be a group. I say this story all the time, and he may be listening to this, especially since we're recording this, but there was a guy out there that started a fund years ago, decade ago, that said, look, I want to buy my first note from you. And at the time we were selling 300 notes a month. So sitting with the guy in a conference room to talk about a one loan sale, that was tough, right? So I'm sitting with him and he says, look, I want to buy 1 note, then I want to buy 3 from you, and then I want to buy 7, and then I want to buy 12. And it was all these odd numbers. And he had this real map of how he was going to scale his business. And today his fund's sitting at 14,000 notes. They show us product. So, and I know that's not everybody, right? But there are large real estate funds today, like this one I was just mentioning, managing $4.5 billion today, right? That also have many different investment funds that they can show us product, or we show them product on. So we're really aligned with tier 1 banks, funds, investment banks, as much as we are with the government. And everyone that does not know, it's tough to get invested and to be approved from HUD, Fannie, or Freddie. So strong partnerships allow us to diversify how we buy and also how we manage and sell. Woo! Got through that.
That was fun. I'm sorry, I sat there. I felt like my head and neck. I'm loving everything you're saying, man. And I think I'm probably not by myself on that one. Everybody is literally just grinning from ear to ear. So let's jump into some Q&A. We've had some questions come through. So I want to make sure that everyone's question gets addressed. So let's go ahead and start. Does investing in the Icaria Fund preclude me from purchasing notes from Revolve Capital, from Revolve Capital's trade desk? Either one of you can jump in. Just kind of make a conversation of it.
I can jump in and answer that. It's a real simple question. No, they're entirely separate. You can invest into our fund. You can also buy notes that we sell. They're completely separate, and perhaps that's a good investment strategy. Have a passive return that builds on the success of our management team, and then have a more active investment yourself by dabbling in the market and buying a few notes yourself.
A hands-on, hands-off approach. Love it. The next question that came through was, I'm not sure if I qualify as a accredited investor. What are the requirements?
I would say, we can point you right to Core Connects, our transfer agent, who will have a really simple, straightforward click-through process. You have to upload a couple of things personally of yourself, your LLC, your investment vehicle that you're using to kind of help qualify that. But it all comes down to just net worth, availability. I think they want to just know basic information on you to ensure that we're both aligned regarding the investment size.
Beautiful. Marc, anything to add?
Yeah, I think the annual income level is 200,000 for an individual, or if you include your spouse's income, it's a different level. And the net worth, as Chaz mentioned, that's another factor. But I think people may be accredited and not realize that they are. So it's definitely worth signing up, pledging an investment, going through the KYC, know your client, and seeing what happens.
Beautiful. Let's see here. Who is your loan servicer?
Because we take down product from different sellers, let's just answer the question straight out. Today it's FCI. I think we've been aligned with good buddies over there, TR Hansen, both Mike Griffith, Tim Griffith, and a lot of the staff, Cassandra, Lucy, saw you guys. And so know FCI very well. And we really haven't steered too much. However, if there is a larger portfolio that we take down of reperforming loans, for example, so they're cash flowing, and let's just say they're at State Bridge, for example, we may keep them there for the time being to avoid the disruption of transferring from servicer A to servicer B, right? If they're non-performing, we're a little bit less concerned about that just because they're not paying anyhow, right? So let's deboard them and take them to our home. So that's the only time that we may have a bifurcation of having multiple servicers, but the short answer is today's FCI.
Okay. This may have come from the same person. Who is your document custodian? Marc, I know you're itching. Get in there.
I can answer that. So Revolve Collateral Management is a new separate entity from Revolve Capital and the fund. So Revolve Collateral Management, one of our sister companies, will be holding our original docs and doing all of our collateral management, curative work, recording, all those activities.
Okay, I'm still looking at questions.
It looks like we got some in the chat box.
Yep. That's what I'm going through. Let's see here. We had some that were preloaded from people's registration. So I want to get through those first, and then we're going to get onto the live ones. Let's see here. If the Fed continues to raise rates and we fall into a recession, how do you expect that it will impact the fund's performance?
We think in a down cyclical market, the market for us gets even better. Why? We feel like the inability for folks, unfortunately, people's misfortune in these timeframes become our gain. And we don't gain off of taking people back through foreclosure. We gain in figuring out how can we help and how can we get them into an investment, because their mortgage loan until paid off is an investment for them as a family, right? So we need to figure out how do we fix getting you back on track, because clearly there was a hardship that caused the default in the first place. So usually though, new delinquency, new inflationary concerns heading into 2023 will put even more systemic pressure on banks today to shed more of the legacy product I was talking about earlier, the 2016, 17, 18 type loans that have been held, that have not been pushed out to the shores like we all as buyers expected. So we feel like heading into the tougher times in 23 will bring exciting times for this fund, because we're going to be able to snap up even more product at a healthier discount than we have over the last 1 to 2 years. And that's because there will be new delinquencies heading onto the balance sheet and even further their delinquencies of legacy stuff surmounting that they must liquidate. They must. Basel III, if you Google that, is a banking requirement that forces all banks, tier 1 banks, to have 10% minimum liquidity. So that is just putting even more systemic pressure on folks having that liquidity there. And we feel like it's just coming right to us. That's why.
Do you purchase commercial real estate assets or mobile homes?
I can take this one. So strictly residential, no commercial assets. Mobile homes are not ideal, not preferred, but as Chaz alluded to, if we see a big portfolio of assets, we're not necessarily able to kick out 1 or 2 because they're not exactly what we're looking for. So mobile homes can be purchased. And just related to that question, we had a question in the chat from Brian, and he just wanted to know if all of the underlying mortgage notes are USA based. So yes, they are. We only invest in USA based assets.
Cool. Yeah, I was about to jump into those because I had the preset questions. Let's see here.
Yeah, no Puerto Rico, Brian.
How soon do you expect the fund to break escrow?
Yeah, I can take this one too. We're very optimistic that we're going to break escrow in the next few weeks, definitely December. We have investors going through the KYC process, know your client process at the moment. So we're excited to break escrow this year, and we're already in diligence on our first 2 trades, and we sure hope they can go into the Icaria Fund.
Okay. And then the last one that was preloaded, then we'll get into the live ones. Are your financials going to be audited?
Yes, 100%. And we have our tax firm that we'll share with you of who will be conducting those audits on an annual basis.
Outstanding. Let's see here. Let me pull up these questions, make sure we hit them. If I'm an investor and I want to buy a single/pool of notes, will I be notified that I'm bidding on a note that I invested in through Icaria Fund?
Yes. Yes. Robin, how are you?
Yeah, I'm sorry. Do you guys want me to say the names? I didn't know if that was needed.
No, it's okay. No, it's okay. I'm familiar with the name. Yep.
Cool.
So yeah, the answer will be yes, Robin. We will inform you.
Okay.
I like that question from Todd Hayes.
Okay, just an FYI, the equity multiples are 1.74x on 100,000 and 1.8x on 250K. Fairly solid for sure, but fairly common in the multifamily syndication world. Looking forward to diving into this further. Thanks. Was there a question there?
Yeah, it's kind of from the above question. I'm not sure if you saw that. So, Todd, yeah, so the quarterly distributions should begin, I would say, fairly early here in 23, because not only do we need to break, but we also need to start going out and starting to allocate. The minute we start allocating, the pref begins to accrue. Okay, so we need to not only break escrow, but we need to start putting that capital right into funds, which we have portfolios sitting now. So we don't have to go and look for product. We have product sitting ready to purchase now. So we are excited to kind of break so we can get allocating and we can start getting going for you guys, as well as the kind of the accrual of the pref getting going. But you had a second part, which is there any liquidity available prior to the 3-year fund period? The answer is yes. We would hope, right, for many of you that are listening, that you are seeing the performance. We all know that it's the trust but verify type of approach. I've always invested that way. We would appreciate you to do the same, right? But let's just say we decide to partner and you get going here, and you start getting your preferred payments hitting on a consistent basis. And now you're starting to see our consistent allocation periods, and you're starting to see the profit spell growing. Okay, and you're starting to see the performance of the fund turning over just as we all projected and modeled for. That being said, we wouldn't anticipate that you would exit the fund at an earlier period than the 3-year. However, you could. After month 12, I believe, Mark, the investors, if you so choose, could begin to unwind your period. So you're not locked in, right, for the full 3-year period.
Yeah.
Okay, so you could choose to liquidate prior to that.
Yes, that's at manager's discretion. So we would obviously handle that delicately with the whole fund in mind, but it's absolutely possible.
Brian Legree also had a question: will the fund's structure create UBIT for IRA investors? And I think we've got a couple of questions about IRA monies. So
Yes. So Paul asked if he's precluded from using IRA money. Absolutely not. We've set this up so that self-directed IRAs can invest in the Icaria Fund. Since we are going to lever the fund, there is the likelihood that it will generate this UBTI, unrelated business taxable income. So while an IRA is traditionally a tax-exempt entity, because the Icaria Fund is going to be levered, it can generate some taxable income. And as an investor, you would just have to file an additional tax return for your IRA.
okay, let's jump in here. Someone's asking, what is the IRR? How many years does the investor need to be invested?
Sure. So I think we did the back of the envelope calculation based on those total dollar returns from earlier in the presentation.
The 30 million and the 75 million, correct?
Between 20 and 22%, like the average annual return an investor can expect.
That was from Frank G. Let's
And then he also asked, how many years does an investor need to be invested? Ideally, to get the full benefit of the fund, you'll be invested for the full duration, 3 years plus wind down. But as Chaz mentioned, if you do need to get out after 12 months, that's something that we can explore.
So somebody wrote in the profit split in the example, I assume the profit could be higher or lower, correct? Yes. I would say that the profit could in fact be lower. I should disclose to you though that we watered it down and actually softened and stress tested our model to the point where that $50,000 example was like haircutted by an additional 40% if we missed our mark, right? So we would really have to fall on our face to just even hit that example IRR we were mentioning to you. So I'm sure many of you probably would agree that we're going to be heading into a valley regarding the residential real estate market over the next 1 to 2 years, at least, right? I think that some are projecting that maybe the rates begin to soften or pull back in Q3, Q4 of 23. That could be optimistic. Let's just say it's early 24, right? There still is going to be a rebound period, right? So in terms of a valley of being able to really being a buyer's market, the next 2 years is going to be a really fun time frame. And then coming out of that 24, 25 period is where a fund like this fund is going to be able to truly take advantage of the market appreciating again, right? And starting to go kind of on an increasing tear. So we find like the timing could be ideal, right? To kind of take full advantage of really the buying trough we see in front of us.
I think we have one more on here from Brian Legree. If the housing sale refi markets are softening, as Chaz just now indicated, who are the end buyers of the note/REO, which this fund will ultimately wanting to sell off?
Brian, our end buyer has been a traditional family. It's been somebody selling their house and then buying our house. And I think that prior to the market being so good over the last couple of years, prior to that, our buying base was an investor. So we were able to kind of get away from an investor buying mentality, which that investor still wants a discount, right? We get it. They're smart. They're sophisticated. They want to get the asset for a good price. However, we were able to max value over the last few years because simply we were able to find a traditional family who got FHA financing, right? And we're able to buy our $450,000 asset for max value. So as the refi market softens and as we start seeing that credit tightens and rates are at an all-time high and it gets even harder to get qualified for a mortgage, we feel like our buyer base will come back to the investor community. I mean, Brian, I think that majority of the market today, if you notice, like the landlord today is becoming a bank or an institution, right? Like Invitation Homes and Colony and BlackRock. I mean, these guys are sitting on 80 to 90,000 rentals, right? And so I find like groups like that, not specifically calling them out, but I think groups that are more of an investor-based community will be our end buyer. We'll price that in as well, Brian.
And Brian had a follow-up. The fund is just now starting. How will it have the cash necessary to fund a quarterly pref distribution? Are distributions going to be from earnings or from other investors' capital?
We purchase cash flowing assets alongside our non-performing assets day one. So very rarely do we go out and buy a non-performing portfolio that has no cash flow coming in on it solely. It's traditionally hedged, meaning we buy non-performing as much as we're buying some cash flow. So for example, we go out and buy 100 loan portfolio of assets. I would say it's a 60-40 makeup, 60 NPL, 40 RPL. So traditionally, usually how that pref will be made up, it should be from cash flowing assets and from sales of that other 60% that's not performing, that we find that are later stage foreclosures, that we find are a little bit more rural, that we find don't fit our specific workout strategy. We're going to be able to generate not only sales from that month one, but also hedging it with cash flowing assets from the moment we purchase.
Beautiful. Todd had a follow-up question. Does the 50-50 profit split happen anytime during the fund as assets are sold or only upon fund closure?
Yeah, I can take that. So it's just upon fund closure. Once the fund has completed its 3-year period of allocation and we begin the liquidation process, at that point, subject to working capital requirements, the profits can start to be distributed.
Okay, I want to say.
Robin, great. I like that Rob question from Robin.
Yeah, Robin's just came through. Will the fund provide a quarterly or semi-annual financial statement?
Quarterly. Robin, I think that's a great point. We feel like the more communication, we really don't mean to be salesy by saying this, but the more communication, the better. We feel like the more you are in lockstep with how decisions, strategies are being made, although you should, really trust our experience. When we're first starting to become partners with one another, I think the more information, the more communication, the better. So we provide quarterlies, we provide yearlies. We also are planning on doing monthly check-in calls, Zooms for all LPs that want to join. We find that, especially in the first year to 2 years of becoming partners, because we are taking a long view of this. You guys have been in this business for a long time and feel like we still haven't seen the fun part of where we're going. And so it's going to be a quarterly answer. It'll be a yearly answer in terms of the financial, in terms of the quarterly, but also in terms of the auditing that you'll be able to have full access to, as well as monthly Zoom calls that we're planning on rolling out.
I think that's all of the questions. I think we nailed everything that was sent in prior, and then obviously while we were live. Was there anything else either one of you wanted to add?
Let's partner. Let's have some fun.
Do it.
Yeah.
Let's go. All right, let's see here. I think we've got one more slide left. Mr. Marc Blunden, I believe you're going to be leading us. Let's see here.
I think the last slide, here we go, how to subscribe.
Yep.
So we've partnered with Core Connects, which is an awesome technology platform to help make the investment process seamless. You can visit, if you haven't already, icaria.revolvecapital.com. You can review the PPM, lots of other information about the fund. And as you see on the graphic on the screen, all you have to do once you're ready is click the Invest Now button. And once you click the Invest Now, it's going to ask you how much you want to invest. It's going to collect a little bit of information, such as, are you investing personally, or is it an LLC that's investing? on your behalf. Information will be collected. You'll submit that information. It'll go through to Core Connects, Jumpstart Securities, who is our broker dealer. They'll reach out to you and they'll begin the KYC and they'll handle the communication from there. You'll receive a confirmation email. In that confirmation email, you'll get a link to set up your Core Connects account. And through that account or investment portal, you can log in at any time, see your investments, see the reports, see upcoming meetings, and manage your investment from there. That's about it. Should be a real simple, clean process.
Wonderful. Well, I mean, I'm excited. I think I'm slightly biased, but I think anyone who's on this call right now who just went through that, questions answered, breaking down the fund. I mean, this is such a huge opportunity. It's, in my opinion, the definition of opportunity, especially when you're looking out there in the market and you're seeing what other options there are for putting sideline capital. Thank you both. Thank you for your knowledge. Thank you for your excitement. Do you have anything else you want to add?
No, I'm good. Thank you, Hayes. Thank you.
Yeah, and thank you all for joining us. We look forward to working with you. Please reach out to us, and we can get you all lined up. Thank you guys so much, and we'll definitely talk to you soon. Bye-bye.